when you're seeing perhaps your wealth being eroded in sovereign bond markets when you're looking at the long end, but finally some bid coming into the short end, how are you seeing the world of bonds vis-a-vis equities, Michele?
Well, I think that obviously the bonds are having an impact, particularly in NASDAQ, as they should. But really, I'm actually sort of flabbergasted how well the market is still being bid up at definitely the lows of the recent ranges, but nonetheless not breaking to new lows. Could be it's ahead of a long weekend or what have you. But I also think that there's still a little bit of a disconnect between what's happening in the bond and the yields and the feeling that this somehow will magically disappear, or the Fed will do no more, or we're just going to keep at this normalization and not really go into any further QT. That's the only explanation I can come up with right now why equities haven't completely fallen apart at this point.
And do you expect them to, or how are you thinking about fair value at this moment?
Well, basically what I'm looking at is the fact that these bounces that we're getting off of these lows are getting shallower and shallower. So there's a good possibility that we'll see another leg down. But I'm still sticking with the trading range stagflation theory. I don't feel that we're going to go into a recession, or the recession will be held off for a while, because even though we're seeing that the mortgage rates have gone up and the buyers have fallen off, the housing market's still strong. The labor market is still strong. And the consumer sentiment was actually up. So these are all other areas right now, but I do believe that we can go lower and then find maybe a new level. And ultimately, I'm looking at about 3,800 maybe in the S&P.
3,800.
38,000, excuse me.
Okay. And then when we talk about where we go in other asset classes here, Michele, I mean, a lot of us are sort of trying to piece together kind of what the next steps are. Then you look at commodity prices, which continue to rise. You look at a dollar that continues to strengthen here. How does that factor into your outlook right now?
Well, I definitely think that commodities are the play. They have been the play so far coming into this year. They continue to be the play. And I still think in some areas, the commodities are relatively undervalued, particularly if you look at it as the ratio compared to equities over history. They were at a 100-year low in 2020, and they're still pretty far apart in terms of the overvaluation of equities versus everything we're seeing with yields and inflation and commodities, particularly if you look at precious metals. So we are really being very careful about equities right now in terms of what we would be buying. It would have to be somewhat inflation-proof, consumer staples, for example, or maybe in the medical and biotechnology space. But otherwise, I think gold and silver, still food commodities, I think they have more upside. The rate of change may not be as great as we've seen over this first quarter, but nonetheless, that's very different than it going down or peaking.
Meanwhile, I mean, just going back to your original stock call, which is significantly lower from currently where we trade in the S&P 500, which, I mean, if we're looking at today's trade currently at 4,424 on the S&P 500, and you're calling for at least in excess of 10% drop. Are there therefore, if you're like in commodities, is it that energy can still be a rich play here? Is it actually that we get outside the world, the United States, and you start going more geographically diversified?
In terms of the energy space?
In terms of equities in general, do you actually look outside of the U.S.?
Oh, absolutely. But what's so interesting about what's going on is a couple of things. Number one is that, some emerging markets are doing very well, particularly the ones that are commodities related. So if you're looking at, say, Mexico or Latin America or Brazil, or even South Africa, those ETFs are doing better. If you're looking at the Western markets, obviously Germany, and today you had Lagarde say that they were going to start some normalization there, which would put more pressure, and the euro being down and the yen being down. Yes, we are sort of experiencing somewhat of a deglobalization, but ultimately, I think all of that weighs heavy on the U.S. market as well.